Contrary to popular belief, dividends are not ever guaranteed to shareholders. And if a business is facing a particularly difficult circumstance that results in a significant loss of revenue, the dividend is typically among the first things to let go. So before investing in any of these companies, make sure you perform your personal research and due diligence and come to your own decisions. A company's strength can be gauged by its track record of never dropping its dividend. While this does not ensure future success, it shows that the company's board of directors has done an excellent job managing the company. They've demonstrated that they can adjust to changing circumstances over time, including various recessions and corrections, without ever having to cut their dividend. Hence, in today's video, we will be talking about companies with a 7% plus dividend yield that has never been cut. So if you're new here on Usable Wisdom, then make sure to click the subscribe button for more content that will surely kickstart your pursuit of great riches. And without further ado, let's get to it. Firstly, there's Whitehorse Finance, or WHF, a closed-end management investment business development company that specializes in the origination of senior secured loans to privately held small-cap enterprises in a variety of industries. They invest in U.S. businesses, often between $5 million and $25 million, in businesses with an enterprise value of $50 million to $350 million. This company has never cut its quarterly dividend since its IPO in 2012. They've been paying around 35 cents per share for almost 8 years. But there have been times recently when they've given a special dividend. These are similar to a bonus that a corporation will pay in specific circumstances. For example, if they had a very great quarter or if the board simply felt charitable. A special dividend is paid by less than 2% of firms, and it is unpredictable. As a result, investors should not expect additional dividend distributions in the future. Whitehorse Finance currently offers a nice 9.22% dividend yield, and they pay dividends quarterly. They are a BDC, or Business Development Company, which is a specialty finance entity that invests in small and medium-sized enterprises, as well as distressed corporations in specific circumstances. These enterprises, such as Whitehorse, provide loans to businesses that have had difficulty obtaining funding from traditional sources. The reason for this can range from a company being too tiny to issue stock, to being too large to simply go to a local bank and request a loan. This is where BDC and other specialty finance companies like it come in to help. When examining a BDC, there are a few aspects to consider. The NAV, or net asset value, is an important metric to remember. This can be found in the company's financial accounts under the heading Book Value on the balance sheet. It's critical to ensure that the company's book value, which represents all of its assets, isn't declining. BDCs often trade around their NAV as well. So in the case of Whitehorse, we can see that the book value as of the third quarter of 2021 is $15.76. This is beneficial since it indicates that the stock is now trending at a little discount. Altria, or MO, comes next. Altria produces and distributes cigarettes, tobacco products, and wine in the United States through its subsidiaries. They primarily sell cigarettes under the Marlboro brand, cigars under the Black & Mild brand, and smokeless tobacco under a variety of brand names. Altria also owns a significant share in Juul, an e-cigarette firm, as well as Philip Morris, the parent company, which is celebrating its 200th anniversary this year. Their stock has a current yield of 7.17% and pays quarterly dividends. They're also a dividend king, a select group of stocks that have grown their dividend year after year for more than half a century. In addition, between 2016 and 2020, Altria paid out more than $27 billion in dividends to stockholders, according to its website. They've also continued to grow their dividend at a faster rate than other dividend kings, increasing it by 4% in just over a year. Furthermore, according to Altria's financials for the third quarter of 2021, the company owed over $27 billion. This is more than double the amount of debt that they had last year when they owed around $11.89 billion. Needless to say, this has many investors worried about whether they'll be able to repay everything. The dividend is normally one of the first things to go when a firm accumulates too much debt, but Altria still has several years before some of its long-term debt obligations must be satisfied. So for the time being, it appears that Altria's dividend is still viable. Their stock has also been in fall for nearly 5 years, but it has been recuperating since the 2020 pandemic plunge. As a result, investors tend to have a little more faith in this stock. Oh, and before we continue, please feel free to comment below indicating the country you're from, so that we can generate content that is more relevant to your region. With that said, let's get going now, shall we? The Goldman Sachs Business Development Company, or GSBD, is the next stop on our list. This BDC focuses on private company investments in the middle market and mezzanine. They aim to increase their capital through issuing secured debt, senior secured debt, junior secured debt, unsecured debt, and shares. The BDC of Goldman Sachs is looking to invest between $10 million and $75 million in companies having an annual EBITDA of $5 million to $75 million. Likewise, BlackRock has its own BDC, which was established in 2007. Although Goldman's BDC has only been established in 2012, there are some things to like about it, as well as some things to avoid. They presently offer investors an 8.83% return, which is very attractive, and they pay quarterly dividends. It's presently trading at roughly 46 cents higher than when it went public in 2015. But it's always paid such a large dividend that if you reinvested your dividends for the entire period, you'd have earned a 9.69% annual return, which is fairly fantastic. Goldman has always paid a 45-cent dividend per share, and like Whitehorse Financial, has given special dividends on a few unusual occasions, about 3 in total. Their portfolio is also quite impressive. According to their most recent investor presentation, senior secured debt made up 98.3% of their portfolio, with first lien investments accounting for 89.5%. However, their declining NAV over the first few years is cause for caution. Despite this, they've been able to maintain the dividend over the years, which speaks to the company's resilience. And at last, PennantPark Part Floating Rate Capital, or PFLT. This gives out dividends on a monthly basis, which is really convenient. This is also a business development firm that looks to invest in secondary debt equity and loans. They attempt to invest largely in the United States and a small number of non-US companies through floating rate loans and private or thinly traded public middle market companies. The funds typically invest between $2 million and $20 million in each business. They also invest in equity securities, including preferred stock, common stock, warrants, and options. They first opened their doors in 2012, and for several years, everything about this organization has performed admirably. While this company's share price appreciation has been almost non-existent, and their dividend has increased since 2015, it does offer a very attractive 8.6% dividend yield, with monthly payouts. PennantPark is likewise a smaller BDC than many of its competitors, and it pays monthly dividends while having a significantly lower yield. If you're looking for a high-yielding dividend stock with a low dividend share price, PennantPark might be worthwhile looking into. As already stated, there is no development, but reinvesting dividends can allow you to build up a dividend snowball if that is something you would like to do. It's important to keep in mind that before investing, you should always conduct your own research and due diligence. Additionally, diversification of your portfolio is vital to lower your risk exposure. Thanks for watching! I hope this video was helpful in teaching you something new. And if you enjoyed this video, please subscribe and click the notification bell for more content like this. Until the next one, bye!